if we had said last year that we would open an envelope and, we would show these inflation prints, we would be shocked and we would have been scared. And quite honestly, in the process in November, when I started selling, I would have sold even more violently than I sold. I just think that right now things are a little bit too calm, and that makes me feel very unsettled.
Hey guys, welcome back to Library of Wealth. Today we have Chamath on the InPodcast giving us an update on the financial market and the unknowns of the economy. Chamath says that it's important to first decide what game you're playing before diving in head first. He says it would make no sense if he, as an equity investor in technology companies, began investing in debt. People would expect him to go bankrupt because he would be out of his depth. Chamath advises to stick with what you're good at because it's hard to excel at even one thing, let alone multiple brackets of assets. He has noticed that when times are very good or very bad, people begin creating meaningless rules, when the only rule is that the markets have no rules. Let's listen to Chamath as he gives his opinion on the current market and what mistakes are being made in the industry. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
What are indications for you that we're either in a bubble or the market is undervalued? Because we're really talking about this timing, right? Timing is very important as a capital allocator.
It's not possible. This is why I think that you have to define what game you want to play before you start playing the game.
Okay.
This is why I think it's kind of nonsensical. For example, I believe that at best, I am an equity investor in technology companies or things that have a technology bias, because I can generally understand them maybe, a few seconds faster than everybody else, which allows me to make a decision a little bit quicker. But if all of a sudden I started investing in debt, you should expect that I'll lose my money because I don't know what I'm doing. And that's not the game where I have any advantage. So I think the most important thing to do is to not try to do all of this crazy stuff, because this is what happens in moments where either things are very, very good or things are very, very bad. People try to create all these stupid rules. And their only rule is there are no rules. So I don't know. I just think it's like, stick to your knitting. If you're a product builder, build products. If you're an early stage investor, just do that. It's hard enough to do any one of those things really, really, really well. But this idea that, you're going to come up with like some mosaic in a system, I think it's just highly suspect. And I think the market returns have showed that everybody that tries has failed except for maybe one or two. Sequoia has the benefit of being able to backtest against 40 years of returns. And so if essentially what they're saying is there's really no more than 5 or 6 companies a year that are worth investing in, that's a really big signal that's worth thinking about. And so, 5 or 6 companies, maybe they can absorb even $600 million each. It still puts you at $3.5–4 billion. Doesn't put you at 20, which is what you need to put 100 into the ground. I think in fairness to SoftBank, again, these are the same guys that invested in Yahoo. They invested in all of these, .com companies and brought them into Japan, including great businesses like Cisco. These guys have been big time serial winners. I think the tactical mistake was not having a 10-year investment life.
Chamath notes that the venture capital company Sequoia has the advantage of being able to backtest up against 40 years of tax returns, which means they are saying no more than 6 companies each year are worth financing and putting money into. Chamath believes this is a cause for concern for the direction our financial market and economy is going. This means that there isn't enough to put the needed $100 billion into the ground.
I don't really know. Look, what are we trying to get from this discussion? I don't understand. Like, are we trying to predict what's going to happen? I mean, I think David basically said it best. Like, if you actually just take a step back and stop overlaying what we want to happen. Look, the reality is all 4 of us want things to go up. And we like it when there's money in the system and everything's flush. But if we had said last year that we would open an envelope and, we would show these inflation prints, we would be shocked and we would have been scared. And quite honestly, in the process in November, when I started selling, I would have sold even more violently than I sold. And all I can say is I saved my ass in November of last year, looking at what's happened in the last 6-8 months. So I don't know. I just think that if you look at the CPI print and you look at the components, we were saved because energy basically fell off a cliff. And for whatever reason, a bunch of people decided not to travel, and we didn't import as much oil, and we were able to keep costs contained, and that kept CPI from being really out of control. But again, we're in the summer where we don't have the pressure on energy that we're going to have in October, November this year. So I really don't know. I mean, I just think that there is, like, Freeberg has his pet issue. I have my pet issue. Sachs has his pet issue. You ask 100 economists, they'll have their own pet issue, housing affordability, whatever it is. The point is, we have 100 whack-a-mole problems. And the question is, which mousetrap sets off the rest of the mousetraps? I have no idea. And so, I just think that right now things are a little bit too calm. And that makes me feel very unsettled.
Hey, if we have increased participation, that's great. Increases monetary velocity, increases participation in the economy. That's a possible path out. Do you feel like that's still holding strong?
We've been in secular decline on that trend for 25 years. So maybe on the margins, a few folks run out of stimulus and decide to go and get a job. But I don't think, again, it's kind of like, when you're at the blackjack table in Vegas, and
clapping as a strategy.
Clapping as a strategy. Is not a strategy. I feel like like what we're talking about right now is clapping as a strategy. Maybe this can happen. Maybe that can happen. You know what? Maybe it'll start raining gold coins that we can use. You've been asking the same question for 3 weeks.
If you guys don't want to talk about the new data, that's fine.
Hey, who cares? It's like we just bounce around from each other's pet issues. None of us, we don't have an opinion other than we don't know.
The multinational company SoftBank has invested in many .com businesses and introduced them to Japan. These companies have become amazing businesses like Cisco and Yahoo. SoftBank has been a giant name and a constant winner in the financial market. Chamath says that their one major strategic mistake was failing to have a solid 10-year investment life. This shows that any company can increase its value and close the gap considerably. Chamath believes that this just goes to show anything can happen in the financial market and no one can predict the future. What do you guys think about Chamath's opinion on investing and the importance of staying in your lane? Let us know in the comments below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.